All right, get in, get settled. Hello, everybody. Hello at the back. Welcome in. Welcome in. Oh, look, I know you. Hello. How is everybody today? You well? You good? Yes, I'm feeling the energy. I'm feeling the love. That was a big whoop. How are we today? Are we well? Yeah, good. That's it. You can always guarantee a whoop from an American crowd. Thank you for having the energy. My name is Simon, Simon Taylor. Some of you may be familiar with a blog called Fintech Brain Food. By day, I also work at a company called Sardine. This is my face. Sardine is the world's best fraud and compliance API. We detect scams, friendly fraud, and mule activity sooner than the competition. By engineers, for engineers, by fraud nerds, for fraud nerds. Come say hi. That's a wavy emoji. Today I'm here to talk about the mistakes everybody makes in fintech. And I'm zooming right out because I'm not a practicing engineer right now, but I spent the first 10 years of my life working with all the ISO files in the world and dealing with every kind of issue, with every kind of reconciliation and break. And so over the years, I've noticed some repeatable patterns and some repeatable trade-offs that you end up having to make consistently. And the annoying thing about trade-offs is traders going to trade. They're a personal choice. They depend on you. They depend on your business. But in financial services in particular, there are some mental models that I've found that really help you figure out who should your providers be, who should your third parties be, what should I build, what should I buy, what should I partner for. And hopefully you can come away from that thinking, well, at least I was entertained today and he was British, but you might come away with it with a little bit more value than that. So I remember first time I was advising a fintech company CTO, that he came out with this wonderful line, which is like, Simon, why are you talking to me about compliance? Why are you talking to me about fraud? I studied engineering, not finance. And I had 2 words for him. Tough shit. Because this industry is the most counterintuitive thing in the known universe, and it was built long before software engineering was a discipline. Everything that you learn in computer science does not work, and that's not your fault, it's everybody else's. So my warnings are, everybody else has terrible technology, and I'll give you some examples of where that's going to trip you up. You need to understand finance and regulation, even if you write code all day, every day. I think that's a critical thing. And API, a lot of things that walk around calling themselves APIs are in fact just a front end to an MQ series message coming out of an IBM mainframe hiding some COBOL. It might be an XML if you're lucky. And even then, the schema doesn't work as advertised. That's just a scientific fact. So don't trust documentation unless it's from something new. And if documentation is from something new, then you've got this trilemma thing that I'll try and remember to talk about. All right. Everyone else's tech is your problem. Sorry to break it to you. You don't have to deal with your technology. You've got to deal with everybody else's. So why is everybody else's tech your problem? Well, let's just take a walk through everybody else's tech and some of the miracles that some of the largest banks in the world are capable of when it comes to their technology. This is possibly my personal favorite thing that's happened from a bank technology team in recent history. Did anybody see when Citi accidentally paid off a $900 million loan? And you wonder, how does somebody accidentally pay off a $900 million loan when they were supposed to send an interest payment of $7 million? How is that even possible? Like, surely there's a calculator could have done this thing. This doesn't take sophisticated software. Well, the problem with everybody else's tech is it's not really tech. So there was a thing called the 6 eyes approval process on any payment, which if you've never worked in a bank is the weirdest thing in the world. So they have a role called a maker, and a maker manually puts payment information into a system called FlexCube, which is a loan processing system from the 19-2 era. The second employee serves as a checker, so they check what the maker made, and the checker checks it. And then finally, the approver checks what the checker did, who's checking what the maker made. And this should catch anything that goes through the process. Slight problem is, has anybody ever seen FlexCube? Yeah, Brody has. It looks like this. What are you checking on this screen? Is it collateral? Is it DUFLUC? Is it fund? Is it interest? Is it principal? Is it complement? And also, by the way, this screenshot doesn't do it justice, but the checkboxes don't quite align. So you've got to worry about that. This is how the global financial system really runs. So every large bank now has a really good developer portal, really great APIs, but not all banks under the hood are created equal. And when you go down outside, and to be fair to Citi and to be fair to the top 20, like they've actually, since this, kind of got their act together and it's a lot better. But the United States does not have 20 banks. It has a lot more than that, and a lot more with APIs and a lot more that you're going to have to interface with. So everyone else's tech is your problem because it's not really technology. This stuff was designed long before software engineering was a discipline. That's why banks behave really weirdly. They fix the fact that they can't change these systems with terrible processes. And they expect you to have the same processes. Because if you walk up to them and go, show me your API documentation, and you don't talk about your 6-size approval process, to some banks, you're going to look like you're talking with two heads. You're going to look really, really strange. And this is kind of my whole purpose in life, is to act as a translator between engineers and banks. And classic example, the mistake every fintech company makes, every CTO, oh, you know what? We've reached a stage where we've kind of outgrown Stripe. You know, we could just build our own ledger. I hear that so often. The reason there are so many ledger as a service startups is because as soon as you try and build a ledger, the reconciliations won't work. The match never adds up. And you're like, hang on, I was trying to do this with a spreadsheet and it was hard. It seems to be even harder now. Why? What? This payment was supposed to come through, but that doesn't match, and they've suddenly changed it. So what you end up building on front of your ledger is this giant series of waterfalls, because Wells Fargo sends the ISO 8583 this way, but they've suddenly started trying and dabbling in ISO 20022s. If it's a consecutive Wednesday and it's a full moon, then they change the file format. And so you end up having to build waterfall after waterfall, and every bank has this thing, and it's not until you hit scale that you realize all of the edge cases that you have to build for. It was Wade that first said it to me, and I thought it summed it up perfectly, which is payments are actually really easy. Edge cases are hard, and it's all fucking edge cases all the way down. It really, really is. And then guess what? You're on the hook to figure that out. You're the problem because the bank is on the hook to the regulator. And so they're going to make sure it feels like your problem the whole way through. And they're going to hold up your sponsorship on front of that. So, yeah, they behave really weirdly. So what do? Well, you could build it, but it's going to take you 100 times longer than you think and cost a load to maintain. But if you do build it and you do eventually get there and you do get enough volume, you're going to have great unit economics. So that's one way to go. The opposite end of the spectrum is to go with somebody super opinionated where you don't have to worry about it. And if that's not how you're going to make money, your unit economics on that thing might not be very good, but at least you don't have to worry about it. I mean, that's Stripe's ultimate value proposition. And then the middle ground is this closer to the metal provider, and that's where the Moovs, the Lithics, the High Notes of the world are starting to make a little bit more headway, this like net third generation of payments company, where as a developer, I can go in and I can do my use case and I can make sense of it. I got to do a bit more work, but they sort of help me understand the known universe. So I think that's kind of your core trade-off. All right. There is no job in finance where you don't meet something called regulation and compliance. The whole thing is upside down and inside out and backwards. So banks are the police of money. This is a thing I did not realize until I worked in anti-money laundering for a little while. And then when you start to think about how that manifests, there's this whole weird thing where banks are trying to keep their regulators happy. And the regulator is in this weird spot where all they see is like a PDF of some system from the 1980s with a list of records on it, and they're trying to make sense of, has there been any money laundering? You know, like, has the bank tried to catch the bad guys? So the regulator is effectively acting as, you know, sort of more like the DOJ in this sense. They're not actually the local police department. The bank is supposed to be the local police department, and then sort of the state federal level, that's the regulator. They're coming in to make sure the bank's doing their job. And then banking as a service came along, and you get all of these third parties that sit between the bank and the fintech program. And so now you're a partner bank, you just have this lack of visibility. You can't see what's going on down the edges. And the only thing you do is you try and make sure that this fintech company, this program that I'm bringing on board, has got some good processes. And that's why they're going to say, can you show me your process for ABC, XYZ? And it starts with BSA-AML, but it starts to turn into, and what's your business continuity plan? What are you going to do about disaster recovery? What do you mean disaster recovery? I run on AWS. Like, what's a disaster recovery plan? And then you realize, no, wait, there's good reasons for this. Because if something does go down and a customer can't get hold of their money, they're going to be on the hook to the regulator. So that's where I think a lot of the risk in the industry has started to really appear, is there isn't an API for reporting to the regulator. There's no real API for all of the things each individual bank needs to see from you in data in real time. And the better sponsor banks are starting to get there. They've got almost like the, here's the kit that you need to be able to, like, just send us this stuff and send us it however you want, and we just want it in a CSV. The other ones will expect you to come sit with them. So it's a real mixed bag. And that's why the OCC ordered Blue Ridge to improve those partnerships, because they were sort of signing deals with fintech companies. The fintech company was going, woohoo, I got a bank account. I'm going to start opening accounts. And now all of a sudden, there's all of this communication back and forth where they're expecting you to send them a PDF, and you're wanting to automate that. Now, some of the middleware providers, the units and so on, are starting to simplify some of this. There's companies like Themis, there's Sardine, there's Unit 21. There's a bunch of companies starting to help with that. But like, unless you think, if you think your job is to make the transaction work, it's not. Even if you get that working and you solve all the edge cases around the transactional behavior, then there's all of the admin, the regulatory reporting, the compliance processes that sort of sits around it, and none of that's automated by default. So you are going to spend your life being bogged down pulling this report, pulling these transactions out, unless you start thinking that through from the beginning. Compliance is hard. People treat it as a checkbox. And whatever you do, you're a third party. You will be deplatformed if you mess up. Like, you are facing an existential risk with your partner bank. Most of them will guide you by the hand and look after you. But the rules have no rules, because one partner bank has a completely different policy to another partner bank. So let's say I'm a fintech company, or I'm a payments company, I'm a SaaS company, and I've just launched my card. And I've launched my card, and I'm doing debit cards, and it's going really well, and I want to do a credit card. But that credit card is with a completely different bank. Oh, cool, but I know how to do compliance now. I figured this out. I've got a policy, and I know how to deal with my... But none of that might apply with this other bank. We want you to do it this way. And it's for exactly the same thing. And again, the middleware providers help with some of this, but that can get confusing and can really mess you up. And the whole provider landscape is a zoo. It really, really is. None of them look the same. They all do something slightly different. So unless you understand the nuances between them, like, you're going to have to invest a lot of time there. So the more time you spend thinking through the complexity of the landscape, the more elegant your code becomes, because the more you realize what problems you actually have to solve are not the transactional ones. It's the ecosystem that sits around what you want to do. And then this is the other mistake everybody makes. I think it was Shamir Karkal on stage last year. Shamir founded, I think, the first neobank in the US, Simple. And somebody asked him the question, when did you learn about fraud? And he said he learned about fraud when he logged into his bank account and saw there was $400,000 less than he expected. And until then, he didn't think he had a fraud problem. And it turns out that's because the fraudsters are really good at what they do. It's got to look like normal transactions. They're going to hit you. They're going to hit everybody else. So if you treat everything you do as a checkbox process, and you just try, okay, I've got to onboard a customer, and I've got to have a SAR process, that's not really what it's going to do. This is going to hit you, and they target young programs. If you are a SaaS company or you are a fintech company and you're about to go build a brand new program, the fraudsters are like, oh, goody, another one. Let's go hit this one, because you're not going to have your program together. Oh, I forgot I had a clicker. I was about to click the screen. So start at risk and work backwards. Everything in the transaction is edge cases. Everything in compliance is risk, and this is inverting. By default, it's like I'm going to build a little MVP, and you should still do that, but when you're starting to get anywhere near production, you almost want to start thinking through some of those edge cases and what you want to do and what your trade-offs are going to be before you go to scale. And make your bank's life easy. Give them real-time data, give them whatever they want, serve it in whatever format they need, and think about how, like, all of the stuff that they're going to ask for, you're just going to be able to spit that out and give them a dashboard, give them whatever they need. Cool. So you've got build, buy, partner. You've got build a fraud and compliance stack. You've got work with an orchestrator. Same for payments. Or you can partner with a specialist. I always like secret option number 3. I like this middle ground. I think that's where fintech's kind of gone. But at the same time, this is a choice. Unit economics versus focus versus a balance of the two. Then this last one, API performance may vary. I think so. I'm just going to leave that there. I think it speaks for itself. This is kind of the case, though, with everything. Really, it's not how good the API and the developer docs are. It's the source of data underneath it, and it's the political landscape underneath it. One of the reasons open banking fails so much is because there's a game of incentives between financial institutions who are having their data scraped and not getting paid for it, and an organization on the front who is scraping the data and selling that for a privilege. The other way to look at that is going, somebody is giving consumers access to data that they already legally own, and they're charging third parties to securely be able to see it. You can argue it both ways. The net result is this. So don't assume that that's going to be part of the, oh, I've installed the API, I'm going to go. So what are your choices? Well, one aggregator is rarely enough if you want real performance. So you're going to have to think, I'm going to need more than one aggregator. Direct to core is going to take you a lot longer, and it's going to cost a lot more. But if you are willing to run the gauntlet and deal with the terrible documentation from most of the core providers, I love you, but it is, even as good as you guys are, there's a long way to go because not all cores are created equal. Like, the reality is, of FIS, of Jack Henry, of Fiserv, there's not one core under there. The different banks are running different software versions, and they're running them in different ecosystems. And some of them have built nice abstractions for it, but that's going to get you that higher conversion rate, but it's going to take a lot longer. It's going to cost a lot of energy and a lot of time. And the same is true of banking as a service. Not all banking as a service providers are equal. Treasury Prime is a very different animal to something like a Unit. Unit is this false service thing that says, we'll help you with some of the compliance, we'll help matchmake you, we'll even do some of the customer service. Treasury Prime's more, we're the software. Like, here's the bank, we'll help broker a relationship for you, but this is the software. It's very different models. So they're selling the same product, they're calling it the same. And what's really confusing about banking as a service is, I always ask, are you a middleware provider, which nobody wants to admit they are? Are you actually doing processing? So are you connecting to the schemes directly for a payment, for money movement? Or are you some sort of program manager? Are you something in the middle? Like, what actually are you? I think it's important to know who you're dealing with, who your vendor and who your partner is. And their business model is really going to matter in that. Again, everything's a trade-off. So I think the big one here is build for failure. Assume that no matter how good it worked in sandbox, it's going to fail in production. It's going to fail often, and you're going to have frustrated customers. So default to thinking about waterfalls. My approach generally is F1 cars, not drag racers. With a lot of vendors and a lot of third parties, the default is, oh my God, I'm pre-seed, I'm seed, I've only got so much runway, I need to get live, I need to get traction, my investors are pushing me, I've got to go as fast as possible. But sometimes doing that, you're going to really annoy your sponsor bank. You're going to really annoy a third party. So the art of this is knowing when to slow down so you can come out the corner really, really fast. Spot those moments of danger. And I think that industry context of where the danger is can be really, really helpful for that. And then lastly, it's look for providers. Did anybody see the movie Blade with Wesley Snipes? Show of hands. All right. So about half. That means I'm old. All right. Blade is a movie about essentially a vampire who can walk in the day. He can walk in the sunlight. They call him the Daywalker. He's rare because he can do both of those things. There are providers. I would point to Moov as being a classic example of people who really deeply get the world of financial services and really deeply get developers. I would say that Chase and Goldman's new APIs, actually, if you go look at Goldman's APIs and transaction banking side, if you go look at the newer stuff from Chase, it's readable and it's clean, but it works. And that's kind of, the world is changing a little bit. So sometimes the non-classical things make a bit more sense than they appear to make. And this was something that my CEO at Sardine said recently, which is every time I have an idea for a fintech company, I realize I need to build the fraud and compliance infra first, because everything is an edge case. Like it really, really is. So if that's one message I can leave you with, I hope it's a useful message and a powerful message. I think I might have just, 10 minutes for questions, and then I got to run and go to the airport because I got to go home, catch the red eye. So thank you very much, everybody. All right, show of hands questions. If not, I'll give you 10 minutes of your days back. Anybody got a question? I'm going to give you time to think because I thought that was going to take me a lot longer than 20 minutes to present. And this is me giving somebody time to raise their hand unless they don't want to raise their hand, in which case I'll leave. There you go. Thank you so much. All right, shout it out and I'll repeat it for the audience. Why is fraud on the rise? No, I don't think it's edge cases. It's a hangover from the pandemic. It's a consequence of everybody going digital by default. So we pulled forward 10 years of e-commerce growth. In order to get a bank account, in order to transact, suddenly a generation of people that have never used mobile before had to use mobile. And guess what? They're really vulnerable. The other thing is, if it becomes impossible to open an account at a branch, and the only way you can do it is online, then the great thing about a branch is it's very, very hard to, as a fraud ring in Nigeria, show up to a branch in Omaha, Nebraska. I mean, you could do it, but it's going to get expensive. Whereas this little online thing, oh, well, I can do that. So I think that was number one. Number two, there are a lot of fintech companies and lots of neobanks all came out around the same time, and they all measured one thing at onboarding. It's called conversion. And if you're trying to optimize for conversion to get people in, because if I can get them in and I can get them activated and I can get them spending, I'm going to have more active users. And if I optimize for that, I have the Shamir at Simple problem, which is like, oh, wait, where did my money go? So I think there's a generation of people learning the lessons that some of the bankers have known for a long time, which is a little bit of friction can be a good thing. And so then the problem is people always saw fraud and conversion as like a pin cushion. I squish down fraud and my conversion goes down. I squish down conversion, and this is horrible. Like, why do I have to have this trade-off? Why can I only have good fraud rates or good conversion? And it's actually not like that. And I think this is probably the one lesson I didn't include in this piece, which is operators who get closer to the detail will deliver better performance. Developers who get closer to the detail and understand the broader context will deliver higher conversion and less fraud. And that's the same of any metric throughout all of it, because you start to spot the patterns, you start to know what to look for, you start to see that sort of stuff. So, pandemic, number one. Number two, a lot of VC cash, a lot of it spent on marketing, the metric being sort of user growth. The metric now has shifted to unit economics and profitability, so I think that's all shifted. One day I'm going to write a blog post called "I Don't Have a Fraud Problem," because whomever's saying that believes they have a conversion problem, and what they're doing is building up a fraud problem. And what they'll do is they'll overcorrect to smash down fraud, and then they really will have a conversion problem, but they won't do so in a nuanced way, it'll be in a panicked way. That's I think, the important thing. Ooh, more questions. All right, I'm going to go to you first, sir. Thank you. Yeah, like, I've actually... For those of you who like the blog, and thank you, that's very kind, I've actually published a new piece on Gen AI, which comes out Sunday, but if you go to the blog now, you can see it a little bit early, because I had a free weekend. And in that piece, I sort of said that Gen AI makes anything 10x more productive if you know how to use it. And a lot of people in regulated jobs aren't necessarily allowed to use it fully. That's not an issue a fraudster has. They're perfectly able to use it. So it's making fraudsters 10x more productive. It's making them 10x more believable. I don't know what your favorite spam email is, but I've collected some just classic spam emails. Hello, Simon, I am from the moon. Oh, hello, Moon Man. It's just wonderful what some of the phishing emails come out with. I'm like, how did you generate that stuff? Now it looks official. If you get something that's from the IRS or from Amazon, it's starting to look really, really official, unless you're checking for the details. So A, it's made them more productive. They can scale it up. It's made them more, and B, it's made them more believable. So I think that's going to be the issue. But the other side of it is you can make the fraud officers, you can make the compliance people who, frankly, were doing a lot of writing a report to file a chargeback dispute, writing a SAR narrative, writing, oh my God, or just checking this email against something else for the text. There's actually a lot of stuff. And I think across the industry, fintech companies are just defaulting into that. That's low-hanging fruit. The harder part is what's happening outside your world. It's like, you could go build that. Of course you could. But could your counterparties? And that's, not to plug it too much, but that's why Sardine X, I think, is really important. Industry consortium for data sharing. We need to get better at that. I know Plaid's launched one, Unit 21's launched one, so more initiatives like that would be really, really good. Julio, I'm going to come to you first. Will there be a better ecosystem for open banking? Well, let's see if 1033 passes. That would be amazing first. Let's just have a mandate. And secondly, I know that the FTX guys have been working on a standard for a while. They're doing God's work trying to make that standard happen. And then sort of secure consumer permissioned is definitely coming. So I can see it, but also the key is actually it's a game of incentives. Everybody's going to have a slice of the pie. We're going to have to get there. And all the way through, from the banks to the core provider to the aggregator to the end, it's got to make sense all the way through. And people often represent their own incentives. They don't design an incentive mechanism for the industry. But the thing I'd say on the other side of it, as you might have noticed, I'm from the UK. We have open banking. And what we have is regulated open banking, so it works 100% of the time, but only for a checking account. And what that's done is it's really limited the window of innovation. So I think the US will muddle through and get there. I think that standards work is one piece of it. I'm sure you're probably aware of others that I'm not mentioning or my brain's not bringing to me. But I think you'll get there. I think you really, really will. Right Foot just launched higher conversion on 100 million accounts. My gut says they're doing something along those lines. I don't know for sure because they're trying to patent it, but that's my guess. Julio. Yeah, don't do that. Well, actually, weirdly, I think the opposite's true now. Starting a fintech in 2021, I mean, if you got a big old Series A during then, and can you grow into it, and you're doing Durbin debit for consumers, and you're not differentiated, it's not looking so great for you. Unless you got a wedge, unless you got to go to market, unless you're seeing traction, unless you're seeing something, then chalk that up to learning. However, when something becomes non-consensus, it becomes a lot more interesting. So the reason I haven't written much about Gen AI is there's plenty of people writing about it. Nobody's talking about how low-key stablecoins are actually taking off. That's kind of interesting. So I always like the counter-narrative. When Web3 was really, really up about 18 months ago, 2 years ago, I was like, okay, calm down, guys. Calm down. It will come. Just not yet. Just not yet. Just not yet. And I think the Gen AI hype is just about to drop off. You should probably do it for your marketing. But fintech has really moved beyond it's just another neobank, and it's getting into some of the gnarly type of products. Now we're starting to talk about charge cards, and we're talking about really interesting products. I was speaking to somebody earlier that was building installments for small businesses in their online banking. When you're going to go make a payment, let's just let you split that in four. So it's like buy now, pay later inside of an online banking portal for payments for middle America. Okay, yeah, I can see that, and that's huge volume, and it's the less obvious stuff, because if it sits on here and it feels like a consumer checking, everybody gets it. Everybody gets what Robinhood is. That's really easy. But this stuff is where the money is. And so I actually think if you go a little bit deeper, I think there's big opportunities. All right, guys, I got to go home. It's wedding anniversary tomorrow. I got to catch a red eye. Thank you very much.